Hello and welcome to Switzer TV Property. I'm Peter Switzer and we go out every Thursday on our YouTube channel. And this is the show where we try to make you an expert on property, and we do that by seeking out the experts who can make you exactly that. On tonight's show, can you trust property price stories in the media? We talk to CoreLogic's Tim Lawless, who says, yes, you can. And then we ask property expert Margaret Lomas, where are the hot spots for property investors? Controversy on the property price front, with the REA's chief economist saying that CoreLogic's data on property prices may well be exaggerating to the high side. We're talking now to Tim Lawless, who's been head of research at CoreLogic for a long time, and we ask him, can we trust property prices? Welcome to the program, Tim.
Thanks, Peter.
Now, I had to get you on the show because there's been suggestions that maybe the house price data we're looking at is not as reliable as we would have thought. And we had REA's chief economist, Nerida Conisbee, on the program, and she doesn't think that the price rises are as general as implied by some media outlets, and that there are only specific suburbs are doing well. What's your response to that?
Yeah, there's a couple of questions there, so I'll address the data integrity one first. So, I mean, Australia is lucky enough to have one of the most transparent housing markets in the world. We see every single property transaction is recorded by the government. It's made available to data providers. And of course, in addition to that data, by the way, can be a little bit lagged. It can take up to 3 months for data distributors or providers to receive that data set. So it's really important that companies add to that data in terms of timeliness. So sourcing data directly from the industry is very important. At CoreLogic, we spend about $20 million a year to acquire, clean, and work with our data. And a big part of that is actually sourcing data directly from the industry to overcome some of the timeliness involved in.
But in a sense that, say after 3 months, your data can be tested against the stuff that's taking a long time to surface.
Well, absolutely. So your government source data is always the Bible. It's the trusted reference point. And any industry provided data is generally overwritten by the government data when it eventually arrives. But the importance of receiving industry data is the timeliness of understanding the market. This is the nation's biggest asset class by quite some margin. So it's really important that we have the best measurements in place and also the most timely measurements in place to see how it's tracking.
Yeah. Okay. So the suggestion is that your indexes are making out that there's a property price recovery, and most people think there is when you look at the anecdotal evidence, but Nerida was saying, well, it's mainly certain areas, and these certain areas are giving an average increase that is not telling the true picture for the whole city or whole country.
Yeah, I wouldn't necessarily agree with that, but I will acknowledge that markets are always fragmented. There's always different performances across different price points, across different geographic regions, across different product types as well. At the moment, what we're seeing in Sydney and Melbourne is very clearly a recovery trend. In fact, it's been recovering since June. Since June, we've seen values in both those cities have risen by nearly 4% on our indices. But I mean, outside of our hedonic measures, which are the market leaders and generally the most recognised for providing a timely and accurate measure on the market, you can look at plenty of other data sources. You can look at some of our competitors. I mean, SQM are reporting a rise in the marketplace. So of Domain, reference the RBA graph pack they put out every month, and you'll see all the different housing indices providers lined up side by side. REA aren't there, by the way, because they don't have a public-facing index, I guess. But that graph on housing markets is showing every single provider is showing an improvement in market conditions, according to the Reserve Bank seasonally adjusted series. So I think we are seeing very clear signs that the market's improving. You can see that in housing credit flows as well. The last 3 months, and this is only up to the end of August, we've seen nearly a 12% rise in housing credit commitments. Clearly, that's a sign that credit has freed up and we're starting to see more buyer activity coming back into the market.
And I guess when we look at the boom, and give me the starting date and the ending dates, say, for Sydney and Melbourne? Were they similar start and end dates?
Yeah, they were. So it was generally early 2012. January, February 2012 was when we started to see housing prices really, were starting to show some movement in both those cities. And it really started to gather momentum as interest rates came down further, investment activity really started to pick up, so we saw a lot of urgency coming into the market, the FOMO that everybody was talking about. Listing numbers fell quite significantly, so there's a lot more competition for a smaller pool of supply. Of course, we saw some disruption to that trend in macro-prudential policies that were introduced in late 2014, APRA, so around interest-only lending and around investment credit growth. And then, of course, we started to see credit tighten up much more substantially around the Royal Commission. And we saw the housing markets in Sydney peaked in July 2017, in Melbourne a little bit later, around October 2017.
Okay. So it seems to me that really Nerida's criticism is based on disaggregating the overall rise and saying, well, these are the suburbs that are carrying the greatest rise and these ones aren't. But during the boom, there would have been suburbs that were really carrying the rise and other ones would have been lagging. They all weren't rising at the same rate.
No, of course not. This is a really important take on the market, is that you have a macro view and you have a micro view. Generally for policymakers and planners and decision making, you're looking at the headline numbers. What's happening across broader Sydney or national, the capital cities? Drilling down, we can see really clearly this recovery is being led by the top end of the market, the top quartile. A stratified hedonic index looks at the top quartile of the market, the 25% of the most expensive properties. It's very clear that's where the growth is coming from in Sydney and Melbourne. But they're also the market segments that fell the most in value during the downturn. So in Sydney, it's your classic inner west, your lower North Shore, to a lesser extent your eastern suburbs. In Melbourne, it was your inner east and your Bayside. And these are the markets that are now bouncing back the quickest after showing the largest downturn as well. Surprisingly, or maybe not so surprisingly, was the more affordable markets around Sydney and Melbourne held up much better during the downturn. I think that's for a couple of reasons. Partly because first home buyers surged back into the market chasing the stamp duty concessions. They came live in July 2017. But also the affordability improvements. We did start to see less competition amongst investors and first home buyers, which really saw some of those markets where housing was much more affordable, holding their values better. Still generally falling, but not as much as the high end.
So in many ways, disaggregating can be misleading in the sense that it's always a market made up of different price rising suburbs. If you want to just differentiate them and pinpoint, oh, this one's doing what and these aren't, it's not necessarily a story that the market's not recovering.
I don't think so, and I wouldn't say it's misleading if you disaggregate the market. It's really important say if you're an individual buyer, you really want to understand what's happening in not just the suburb you're buying in, but the street and individual property. You want to know how long it's been on the market for. You want to know how long has it been held by the current owners. What was it previously purchased at? What sort of rental yield are you likely to get as an investor? So as a buyer, you really want to do your diligence right at the micro level, okay? But for decision makers, you're generally looking at broader trends.
Is there any history of ripple effects that, certain suburbs lead the charge, then they become essentially overpriced, so people look for the next suburbs and that then spreads right across the city?
Yeah, of course. I mean, that's a natural phenomenon. I think we've seen that repeatedly over each of the housing cycles. Even at a more broader scale, you could see that in price growth moving out of Sydney towards the Gong or Illawarra and up to Newcastle on the Central Coast. In Melbourne, it was spreading out to Geelong and then to Ballarat and Bendigo and Latrobe. So it's really clear that as prices become very expensive in one area that's highly desirable, it's simply the demand tends to move out to the next best option.
Do you think there's going to be a resurgence in house prices like we saw 2012 to 2016?
No, I don't think that's going to be the case. Not necessarily because the trends at the moment seem to be pointing that direction, but I think if the market does become too frothy and we start to see a lot more speculative activity, that's probably where we'll start to see some further regulatory intervention. I think the last thing policymakers want to see is a further rise in household debt, particularly housing debt. If you look at the household debt to income ratio, 70% of that debt is held in the housing asset class. So I think we will start to see, if property prices do get up to, say, 2015 levels in terms of price growth, we could start to see some of that intervention, probably more around stymieing debt accrual in the form of, say, limits on debt to income ratios for lenders, or limits on LVRs, like what we've seen in New Zealand.
Okay. One last question, and just thinking about this as you were answering then. A lot of people who, like to criticise anyone who thinks that rising house prices are a terrible thing, they often describe the housing sector as one big Ponzi scheme. What do you say when you hear something like that?
Yeah, I mean, there is I suppose, an element of investment in Australian housing that's quite unique to Australia. And that's probably where those comments are coming from. But when you look at housing as an asset in Australia, this is about just over 50% of household wealth is held in housing. So that's why this asset is so important. It's why regulators and policymakers are generally very interested in what's happening in the housing market's performance. Of course, as housing values fall, that has a real negative consequence for the economy, because it does have a reversal of the wealth effect. People spending less, people less confident, people less willing to go out and buy discretionary items. And that's exactly what we've seen over this latest housing market downturn that's weighed on economic growth in Australia.
But I've always thought that a Ponzi scheme is actually based on a fraudulent proposition. The fact that people are prepared to pay too high a price for a house doesn't make it a Ponzi scheme.
No, I don't think so. And you can clearly see there's been some very frenzied activity in the markets, particularly in Sydney and Melbourne through the growth phases. But it's nothing resembling a Ponzi scheme. There's a lot of investment in the market.
And I guess there are people in the 70s who may well have overinvested in property, and someone could have said they were victims of a Ponzi scheme, but if they stayed in the market, they're multi-millionaires nowadays. The Ponzi can be reversed. Great, thanks for joining us, mate.
Thanks, Peter.
That's Tim Lawless from CoreLogic.
Basically, the economic analysis is very interesting, macroeconomic analysis, and of course Peter's very entertaining.
Well, I come every year or twice a year, and I love it because I get so much information, and I run my own super fund, so for me it's really, really good.
It's been very, very informative, and I must admit, some of these share fund managers, they're quite funny, and I think they've made it such a pleasure to be here. So I've loved it. Looking forward to doing something with my money and becoming rich.
Got a lot of people who are very talented people in the industry. We are getting expert at one place, so that's one of the best thing I've found here. And I would like to thank Peter Switzer for organizing this for us.
Just having the exposure into the market and looking at constructing a portfolio, I think it'll be just a great experience. Just meeting a lot of people as well.
Oh, I really enjoyed it because I came really looking for some income stream because it's just not worthwhile for me to keep my money in the bank anymore, and it's given me some really good ideas, the options that are available there. So yeah, it's been really positive.
It looked really interesting about going into investing and more like building your wealth for the future, and not just relying on, say, an income and stuff like that.
I've always believed in a great line that my wife taught me, Maureen, but she quoted William Blake once, and she said, Blake once said, "Without controversy, there's no progress." And that's, in many ways, the relationship I've got with Paul and the relationship I've got with Maureen as well. In relation to Maureen, I always say, she actually decided to become my life coach, even though I didn't even know I needed one. But without her looking at me the way a Labrador watches a sausage at a barbecue, finding out what I'm doing wrong and actually telling me how I can fix myself up, I wouldn't be here today. So that's why I always say behind every successful man's a very surprised woman. I'm joined by the wonderful Margaret Lomas of Destiny Financial, and I want to talk to her about many things around the property space, particularly the mistakes that people make when it comes to property investing. But I also want to get her take on the current environment. Margaret, thanks for joining us.
Thanks for having me.
So Margaret, at the moment there's a bit of a rivalry going on between the data collectors CoreLogic and REA. And REA's narrator Conisby, who I know you know, is kind of raising doubts about whether CoreLogic's data is actually telling us the complete story about a house price rebound. Have you thought about that?
I have thought about that, and I'm finding that there's a lot of conflicting information at the moment, particularly around auction clearance rates. And I read a figure the other day that said that the official auction clearance rates were 72%, but when you actually went back and looked at the data, they were really only 51% and not 72% at all. So, I think one of the biggest problems that we've got at the moment is that we're still relying on this historical data to tell us what is happening in the market, when in reality, the best way to tell what's happening in the market is just to be in the market and, get out there and see what's happening for yourself. I doubt a lot of these figures about these are sold for X amount over the reserve, and happy to talk about why I doubt that, but there's just so much information out there that's conflicting at the moment.
Okay, so from my point of view, and I come at this as an economist rather than the property expert that you are, but it seems to me, considering how bad the price data seemed between 2016, 17 and 18, I guess. What I'm seeing now to me looks like a bit like a bottoming process in the house price fall. Am I wrong to assume that?
Look, it's easy to get data when you've got so many sales going on. So it's very easy to sit there and predict or at least observe that prices are going up and that people are going crazy, and you can feel it and see it in the market. You only need to attend an auction to see, many registered bidders and properties that are selling for what feels like impossible prices. When you get to a situation that we have now where listings are well down on what they were a couple of years ago, and yet buyers aren't as down as what they're saying they are, then we have a situation where we've got relatively more buyers for the amount of properties that are available. And of course, this is then going to translate as being an active market. But in reality, if we had the same number of listings as we had a few years ago, the market would be really sitting along the bottom and not doing terribly well. So we've got to take into account all of these things. The other thing that I think we need to take into account is that we're hearing all of these reports of properties that have sold for X amount over the reserve, but we need to be careful we don't confuse that with X amount over market value. Just because a property sells for $100,000 over its reserve doesn't mean that its reserve was anything like a true reflection of what that property was worth. It could have been an excellent real estate agent who managed to condition their seller down to the point where they were prepared to accept a low offer, spoke about the gloom and doom in the market at the moment, and therefore they set their reserve quite low. And so I think we have to be careful about how we look at that data and what we actually take from it.
Okay, but my problem is, Margaret, and I want you to help me understand it because as you are the property princess, as I always call you, maybe you're more than a princess. The thing is this, that if you can't believe that that the property prices are recovering, then do we devalue the property price slump and we devalue the property price boom, because the same kinds of processes were being used when we talked about a bubble and then we talked about a collapse. How do we get the truth?
Well, it's hard to get the truth because we've got so many people taking data at different points in the market as well. So people are measuring their data differently from each other and then reporting it. And then we get the media saying, this is what's happening in the property market at the moment. And then we get all the buyers and sellers reacting to that news, and it almost becomes a bit of a self-fulfilling prophecy. I think the most important thing for buyers to always be in touch with is what a property is worth at any one point in time. And I know that's difficult to tell, but it's all about knowing exactly what sold in the last 3 months and what it sold for. Something isn't going to sell a month ago and then the same property a month later sell for 100,000 more if it's a similar property in the same shape and size. I guess in response to the queries about, are we bottoming out and are we at the bottom? I think what is really happening here is that during the height of our boom or bubble or whatever term you want to use to describe that, properties were most definitely selling at over and well over market value because people were panicking and wanting to get in and thinking that they were going to be too late. So they were paying anything. We had many more buyers than we had listings. And so it was easy to panic and to think, I've got to buy now. So properties sold at well over their intrinsic market value. Then after that started to settle down, a lot of the buyers were taken out of the market and sellers took their properties off the market. We then saw what looked like a price drop. In fact, I think that was just properties adjusting back to where they should have been in the first place. Now, if you want to call it the bottom, call it the bottom. I just call it the point of stabilisation where we've now gone back to sensible.
Okay, good. Now, so given that then, are you seeing the loosening of credit, because APRA was a part of, killing off the bubble or the boom, and APRA's gone softer and therefore banks are able to lend more. Are you seeing that as being a helpful development for the property market?
I would like to say that I am, but it isn't manifesting itself that way just yet. And to give you an idea of what I'm talking about, somebody who 5 years ago could have borrowed, let's call it $2 to $2.5 million to buy 4 and 5 properties for their portfolio, today on the same income is lucky to be able to borrow for a third property. So the banks really are making serviceability very difficult. And this is because even though they are no longer required to set what we call the benchmark rate, which is the rate at which a loan is approved at 7.5%, which is where it was, they're still really required to put in 2 to 2.5% of a buffer. The banks can sort of they can judge that on their own, but they're all putting in this big buffer. But more importantly, for investors who typically will have a principal and interest loan on their own home and an interest-only loan on their investments, they're being assessed as if they have P&I loans on everything. So it can double your serviceability, so to speak. It can double the amount of money on paper that you're paying out on loans when you're not really paying out that much, and it just puts a big hole in your serviceability. We're not seeing much loosening up of that at the moment. Someone who is out to buy their first property can borrow more than they could a year ago. But someone who is looking to build an investment portfolio and go past that magic number of 3, just as much struggle now as they've had for the last few years. So
are you saying then that the bias against investors is still pretty strong?
Absolutely. And it's interesting, I don't know if you caught the news last night, you probably did, where there was an interesting story about how politicians have these big investment property portfolios, and when you looked at them, one had 3 and one had 4, and all those politicians were doing is what every person in Australia who is interested in property wants to do, which is to build a bit of a portfolio for their future. But they were being slammed as being, these wealthy politicians who had all of these properties under their belt. And I think part of the problem is that attitude that once you get past 3, you're wealthy, but in reality, you're not really, when you think about the borrowing, the equity, the amount of money it's costing you to hold them and get them to the point where they're going to return something to you.
Margaret, do you think we have a supply of properties problem in Australia?
We do definitely have a supply problem in many parts of Australia, and in some parts it's an oversupply, in other parts it's a definite undersupply of property. At the moment we all know there's an oversupply of apartments, and we saw it coming and talked about it for a long time, so that isn't any surprise to anyone. Sydney market is oversupplied a little, but not so much that it won't be taken up in the next couple of years. Melbourne has parts of it that's very, very oversupplied, and Brisbane is just coming off that oversupply. And really in Brisbane for apartments, it's more about attitude than anything, because they're not quite ready for that big urban living like we are in Sydney and Melbourne. They're not forced into buying apartments if they want to be near the city, because affordability is still in that market everywhere, houses and apartments. But we've definitely got some oversupply in the apartment market. There are still areas though, and many of them are suburbs where we have a big family demographic that is still relatively close to the city. Many of those markets are undersupplied, and they're the ones that we're probably seeing leading a little bit of what looks like a recovery in Sydney and Melbourne when you take the data in for the whole city.
Okay, now I didn't tell you I was going to ask you this, but you're always ready for me. The places that you like now, when your clients come to you and say, Margaret, I'm ready to buy an investment property, what areas are you pointing them at?
Well, you know I always like Brisbane, and I'm really pleased to report that I've got Louis Christopher tonight on my show, Louis Christopher from SQM Research, and he actually is going to be telling us why Brisbane is going to make a good play for 2020. So I'm excited about getting that information out of him, and then I can bring it to you after I get it. Yeah. But one of the things about Brisbane is that in the mid-ring of Brisbane, we're actually seeing that undersupply, but a creeping demand from those families who now want to trade up out of their outer Brisbane homes and start to get that little bit closer to both the coast, the city, and also then the airport. And so there's a lot of affordable properties in that $500,000 to $650,000 range in Brisbane that is getting a lot of pressure on them. So I think anywhere within, say, the 5 to 10 kilometre ring of Brisbane is really going to present good buying for people, and you will see it move in value fairly quickly. I always like Adelaide, if not for the fact that it just grows a little bit every year. But the important thing about Adelaide is everybody who wants to invest there has to note that you can't just go and buy any property in Adelaide and hope that it's going to grow. You've got to be very selective and picky about Adelaide. And at the moment, there's a lot happening up in the northern suburbs and the northeastern suburbs. We've got the Tea Tree Gully Council really doing a lot to their area to actually make it attractive and livable for families. So we're starting to see what was formerly a pretty low socioeconomic group start to change over, and we're seeing managers and more professional trades moving into that area. So that area is actually moving a lot more quickly in terms of price than many other parts of Adelaide. But Melbourne, let's not forget Melbourne, and there's certainly a lot of renewed interest in that southeast corner down toward the peninsula, in and around Frankston, Narrewarren, Berwick, those kinds of areas. Seaford on the coast if you really want to live right near water, but in behind there, there's quite a lot of suburbs that are really affordable at the moment that are getting a lot of attention. Yeah,
I must admit, I think my wife wanted to pick up a lemon tree in a suburb, maybe like 5 minutes from Seaford, and I was staggered how close the water was and how reasonable the property prices were in the area too.
Exactly, and so that's going to attract a lot of buyers.
Okay, what about in Sydney? Is there any place in Sydney that anyone can go and find good value?
I guess the problem at the moment is that whether or not we're getting toward the bottom of, the cooling, and whether the prices are going to turn around or not is really not the point to make if you're a buyer. The point to make is that it still costs you an arm and a leg and a couple of your kids to get into the Sydney market. I was talking to my son-in-law the other day, and he and my daughter had gone down to Sydney to a birthday party, and he said that their friends are paying $7,000 a month as a mortgage payment. Now, to me, anybody paying $7,000 a month, it's really got their work cut out for them, and that must be a highly stressful way to live. And I said to him, well, why don't they rent? They could rent in that same area, which is the Northern Beaches, and probably only pay $3,500 a month in rent, and then take all that lovely money that they're throwing away to the bank, to the interest to the bank, and invest it in other areas that cause them a little bit less stress and will grow just as well, if not better, than an area that's just come off its hottest time in recent history.
Yeah, well, you're a very rational person. I suspect those people aren't rational. Margaret, some of the key lessons for people out there who might be thinking, gee, I wouldn't mind being a property investor.
Look, if you're looking to buy a home of your own, first of all, I really think it's time for that reset of values that we need. I was raised by a person, my dad, who insisted that I had to own my own home. But I think what he really meant was that it would be good for me to own property. And I wish I had have known much earlier in the piece that I didn't necessarily need to throw good money away on areas that were at the peaks of their markets where I couldn't really gain a lot of equity. And instead I could rent where I wanted to live and invest in markets that were just on the verge of growing in value. I wish I had have known that. So for homeowners, you know, it's okay for you to rent. It's not a dirty word, renting. And very often it makes more sense to rent where you want to live, to be near your social networks and your work and your family and friends. It makes more sense to do that as long as you're investing in something, whether it be property or a share portfolio or managed funds, as long as you have an investment program going somewhere on the side as well as doing that renting. But for property investors, just don't be caught up in all of the media hype about whether markets are growing or falling and whether it's you're too late or too early or whether it's too hot or too cold at the top or the bottom. Just as you know, I always say, Pete, know how to do that research, because if you do understand what drives property growth, you can buy in an area that will grow in the period of time that you own that property, and you'll do okay out of that.
Margaret, thanks for joining us.
Thanks for having me.
That's Margaret Lomas from destiny.com.au.
Basically, the economic analysis is very interesting, macroeconomic analysis, and of course Peter's very entertaining.
Well, I come every year or twice a year, and I love it because I get so much information, and I run my own super fund, so for me it's really, really good.
It's been very, very informative, and I must admit, some of these share fund managers, they're quite funny, and I think they've made it such a pleasure to be here. So I've loved it. Looking forward to doing something with my money and becoming rich.
Got a lot of people like who are very talented people in the industry. We are getting expert at one place, so that's one of the best thing I've found here. And I would like to thank Peter Switzer for organizing this for us.
Just having the exposure into the market and looking at constructing a portfolio, I think it'll be just a great experience. Just meeting a lot of people as well.
Oh, I really enjoyed it because I came really looking for some income stream, because it's just not worthwhile for me to keep my money in the bank anymore, and it's given me some really good ideas, the options that are available there. So yeah, it's been really positive.
And it looked really interesting about going into investing and more like building your wealth for the future, and not just relying on, say, like an income and stuff like that.
I've always believed in a great line that my wife taught me, Maureen, but she quoted William Blake once, and she said, Blake once said, "Without controversy, there's no progress." And that's, in many ways, the relationship I've got with Paul and the relationship I've got with Maureen as well. In relation to Maureen, I always say, she actually decided to become my life coach, even though I didn't even know I needed one. But without her looking at me the way a Labrador watches a sausage at a barbecue, finding out what I'm doing wrong and actually telling me how I can fix myself up, I wouldn't be here today. So that's why I always say behind every successful man's a very surprised woman.